participate. You bought in some insurance along the way that's been, like insurance where, you pay and you don't get anything back.
Yeah, yeah. Very short-lived policies before stop out.
Yeah, short-lived policy strategy.
And thank God I got myself stopped out. I had one that I lost 10% on, and that was not fun. But most of them I took a 1%, 2% loss. Usually it could have been a day, could have been a week, could have been 2 weeks, but didn't last around. I never came close to getting the top, my friend. Other than
I'll
the
tell
top
you.
in February. The top in February we caught, and I booked nice profits in that one. That
All right,
doesn't even
so
count.
the spy, let's just talk about the spy. I guess the spy went 674 to 653 to 665 to yesterday morning 653, and now it's at 668. They say that in phase transitions, the speed of atoms speeds up as you move from a solid to a gas. And so
Right?
the volatility increases as you transition from one phase to another phase in physics. And so I guess you could say that seems to be going on right now.
Ben, I like Barton Biggs' old saying, "How's a bull market like sex?" It
I don't know
feels
how.
best. It feels best right before it's about to be over.
That's a good line. Wow, I never heard that before. That is very solid. Hang on. Do we have a link
And
here? I can tweet up.
I think we're feeling best right around now. Again, I
Yeah,
hope it does. I hope it doesn't last 6 months, like Paul Tudor Jones suggested it could.
I mean, could I don't know. I mean, right? Like, hang on. Let me tweet this out 1 second. Mm.
Where's the link to tweet it?
I think it's in the WhatsApp
There it
group.
is. Got it. Got it. I see it now. Yep. Come on, load, sucker. I'll get
Yeah.
this too.
All right. Cool.
No, it's not working for me. But where is it? I can't. I'm sorry, guys. What? Yeah. What's up? Okay. You got it. I gotta take some of my things out of here. All right, I'm back.
All right. So, all right. Let's see. I think we're good to go. All right. Let's rock and roll. You ready to go, buddy?
I'm ready to rock and roll, buddy.
Just like this market, ready to rock and roll. All right.
Yeah,
So
rock
it
and roll.
is. I'm just getting back from being sick. It is corporate tax day, Wednesday, October 15th, or not corporate tax day, but the final delay
Extension day.
tax day. Yeah, extension
Extension
day.
deadline, yes.
So I just got my stuff in. Because why would you ever pay the government and file the government or do anything for them in time? All right, so let's go. Wall Street Beats. I'm Benjamin Brey. This is Robert Marcin. It is Wednesday, October 15th. As mentioned, it is getting colder, but not apparently in Philadelphia, except for the Eagles. They seem to be a
Which
little bit colder.
which Ben knows I've been complaining about all year, even when they started 4-0, right?
You were not necessarily a buyer, but your heart was a buyer, so that's true. Um, the question is, are they going to get it together, or will they do what they did 2 years ago and just kaput? But people are not here to hear us talk. This is not a football show. We could do a sideshow, Robert, me and you, talking about football. See if we can get some viewership. Um, what are we thinking here? So like I was I've been sick the last 2 days and haven't been. I mean, I kind of saw the markets and stuff, but so Friday we're down 5% in the aftermarket. We're down 4% in the Nasdaq, then another 1% in the aftermarket, and then Trump says something, and the market kind of is a fake rally. And then yesterday morning we're plumbing the lows. The banks come out. There were decent little credit deterioration at JP and the other ones, but since then have rallied. So now we're almost reclaimed the entire move. What are you making of this? And just so that our listeners know, Robert has been a begrudging protect and participate guy saying respect the rally since April. What are you thinking here?
I Yeah, well, I was caught off guard by how severe the correction was because I entered the last year. I had year 100% long. I raised 25% cash in February, expecting a correction. When it hit, it hit the small cap so badly it knocked me on my butt, but I didn't sell anything down, and I actually got all the money to work in the next couple of months. And last year, at times, and this year at times, I've used the phrase "respect the rally," and that was, just because of, as you know, I'm very fundamental driven, very valuation driven, and it's hard to be a bull with the market where it was for the last 18 months, right? Market's expensive on price to sales. It's expensive on free cash flow yields. Expensive on its top, few percentile on every metric out there, right? On earnings, but the market had never investors had never bought into the market and into the bull market in my mind, and the correction in the tariff tantrum, we'll call that triple T, scared the bejesus out of him again and pushed out the ultimate, euphoria high that bull markets can normally see. And even at 3 years, this would be a very short bull market if it ended. But when it ends, there's much more risk because valuations are so much more elevated. So my respect the rally phrase, was in existence in 24 and in 2025, despite being punched in the mouth for 6 weeks in early 2025. And it's just because I didn't see the signs of capitulation, euphoria, investor bullishness, never got to a classic sell signal. I like to use that as a sentiment. And it just felt to me that people were begrudgingly buying this bull market as well as perhaps they should. But it doesn't mean you should be shorted in a big way or selling all your risk on stocks for the PepsiCos and the Proctors of the world. I really don't think that's where this market is. So you want to participate where you can find value, especially if it's unrecognized, and you can make some real money if the market discovers what you think you know related to an emerging growth story. Okay, that's the model. And Ben, on this I'm on this stream. I think in the last 2 months, I may have brought up three completely new additions to my portfolio. Two of them have gone up 30 to 40% in a couple of months, sort of joining the party last minute. And Everspin was the magneto resistive semiconductor company I brought up around 7. It's close to 12 today. That was probably 8 weeks ago. And the other one was Tetra Tech. That was the company that makes oil field service products and has the EOS battery companies, electrolytes, and a commercial plants for processing all this produced water from the Permian, which is a massive problem and going to get tens of billions of dollars thrown at it next few years from very small amounts today. So I did that at 5. I think it's 7.5 today. I mean, you can get paid in 30 days these days if you have something that transitions from a no growth business to we see the growth opportunity. So that's what I'm looking for.
Yeah, it's interesting because I've been kind of in the boat that the defensives. I mean, you saw defense. I mean, XLU, for example, is at the all-time high. It's kind of gone vertical. XLP's off a little bit, and XLV, which has been a pariah, has even gotten a bid and is not quite at the high, but it's traded well. But the spies and the Qs are still off the highs. The IWM, your neck of the woods, is actually the leading with the utilities right now.
I mean, Ben, every day the people feel more sanguine about the Fed cutting rates. They get the same benefit that gold does from the rate relief trade, in my opinion. You know.
Yeah, I guess that's kind of where the rubber will meet the road is why are rates going down? If you're bullish, you have to be bullish on the idea that rates are going down and that things are fine. If it's rates are going down because growth is eroding, then there'll be an oh shit moment. You know what I mean?
Yep.
Uh,
Yep.
where people will realize that you got to be that defensives over let's call it financials and risk, tech and all that stuff. But in the meantime, ASML had a good print last night. It's up 5% today, and ASML is one of those. Robert, you were a semiconductor guy for a long time. Do you think that anyone realizes the absolute fragile nature of the semiconductor supply chain? It's like when and I'm not an expert by any means, but when you think about, okay, there's one mine in the world that does the quartz in North Carolina, and that's the only mine. And then there's one company in Europe called ASML that makes these machines that Taiwan Semiconductors needs. And then Taiwan Semiconductors, the only company that can do this, and we have all this market cap. Doesn't that seem a little bit fragile that there's all these just lack of robustness along the supply chain?
It very much does, and that's why I own a bunch of small cap missile defense companies for if anything happens to Taiwan Semi and the island of Taiwan. If China sails the fleet, you got to have, or if a tsunami hits, it could be something like that. It's in an earthquake prone area as well, right? So
Well,
it's
that was what
it's
happened
very.
last year at current.
I mean, Ben, we've been, I think that yes, people realize now how fragile the supply chain system is for lots of products, not just semiconductors, and that's why there's a major effort to repatriate supply chain, inputs. It's why I think there's a U.S. based, can't remember the name, packaging company that barely has a $5 billion, $10 billion market cap, spending $7 billion in Arizona to package semiconductors from from that Nvidia and Apple are producing through TSMC in Arizona. I mean, it's a massive investment for a small company, but the process has started. People have realized it. So Yeah, it's going to take a decade to where the problem will be fixed. Okay, but they have recognized it. Yes, in my opinion.
Yeah, so okay, now I'm with you. Like it's one thing to recognize it, and then I guess the market in general, one of the problems is that, a lot of people are taught the McKinsey thinking of, or banks of, let's optimize for the middle of the curve and maximize ROE, which usually means minimize robustness, right? Like,
Yes,
would you agree? Would you agree if that's how things work? And that's
that's
how
how things
bonuses are
work.
paid,
Yes,
and that
for
that's that.
30 years. That's how things have been for 30, 40 years. It's ridiculous.
y-
We
Yeah,
got
I
at
mean,
the industrial base of this country for corporations
ROE.
to go from record profit margins 20 years ago to more double record profit margins today. Correct.
Yeah, so there's nothing free. There's no free lunch, if you will. And so when you do that, it's kind of like what causes something like Friday, where you get a stupid tweet causing the market to go down 5% in a couple hours. Well, there's a lot of zero DT vol sellers, and there's these leveraged ETFs, and there's a variety of different vol selling trades which work most of the time. But then you build up leverage, and it's what we're talking about is a much larger time scale or longer time scale, but it's all kind of the same thing. And so I just wonder about that. Is like when I look at all these critical pieces along the chain in semiconductors, I just wonder how we can confidently price so much market cap, where, because again, last year with that hurricane in North Carolina, that, Trump part of his election campaign, where they were talking about how Biden and those guys forgot about them. I don't know if you remember that, but that was really close to there. And if you flooded those mines, that could screw up the supply chain. And it's just a stupid natural disaster that happens, and not even as you know, not even like, oh, you're going to invade Taiwan, but any of that kind of stuff, like low frequency, high impact events, just seems like we're extremely vulnerable to that. So there's something worth thinking about that of like, oh, what would a tail event price? And, how would you play that in this? But along those lines, let's talk about one of the ones you pitched on the show a year ago, SIMO. How are we doing there? Silicon Motion. Speaking of
Oh,
the supply chain.
yeah, I'll give you a quick update on Silicon Motion, and then share the stock I did want to recommend because I bought it yesterday. How's that?
Oh, great.
We're at record highs. We're at stupid valuations, right? And
Yep.
everything's grossly overbought. And I'm a guy whose formula is I only buy things down a lot, the compelling valuations with very good fundamentals, right? But an obvious threat to those fundamentals because that's why it's down a lot and cheap. That's my formula. Simple, right? And I
Simple
found a new name.
formula.
That's the formula. I found a new name that I bought yesterday in this crazy ass market that fits that. Okay, I could be wrong. The numbers could, turn around and erode like they did for Crocs on me, which that was one that fit the formula at 100 and it's 80 today. So I'm not always right, but maybe three
Can't
quarters
always
of the
make. You can't win them all. Can't win them all.
maybe three quarters of the time I'm right. And that's a pretty good batting average in this business. So SEMO, it was 85 a year and a half ago. It dropped to the low to mid 50s. We bought it there. I didn't buy more in the panic, although I tried. I didn't hit the ask on an option bid, an options purchase because there was a huge spread between bid ask, and I would have doubled my position.
Yeah.
I wussied out. I was worried about issues in Southeast Asia, geopolitical issues in Southeast Asia, and I didn't buy stock at 40. So shame on me. It's delivered the fundamentals that we thought it was going to deliver. When, by the way, it was down a lot and compellingly cheap with good fundamentals. So the fundamentals were bottoming then. They were not. They were bad fundamentals, but they were bottoming. And when the new product upcycle kicked in, the company was going to have a very impressive growth spurt. So that's starting, um, and it's not even being driven by AI yet. AI won't kick in until next year, and 26 and 27 in bigger ways, and then the growth spurt from their data center and their hyperscale business doesn't kick in until 26 and 27. So, the numbers I get, which I shared with you, which is a very good case outcome for this company. I think they made like $3 last year, less than $3. They're making $4 this year, $6 next year. Is if this enterprise controller kicks in for storage for data centers, from nothing to about 300 million in revenue in 3 years, which is about a 5% market share for them of the business from zero. They'll make about they'll go to about a 1.6 billion, 1.5 billion in sales from 800 million this year, and they'll make $10 in earnings in 2028. So I would put a 20-25 PE on $10, even if it is headquartered in Taiwan, because you get paid for Taiwan semi. So I think in 2 to 3 years it could be a $200 stock. So it hit 100, it bounced off of that backwards, and I'm just holding it for 2 to 3 years with a $10 earnings target 3 years out and a $200 price target. But it's full speed ahead for all their product lines. They are very much ahead of their peers in NAND flash controllers, and some of their bigger competitors, which happen to be companies like Marvell and Broadcom, are actually not investing in next generation products, seeding the market, if you will, in a passive way, because they have way better and bigger fish to kill in these ASICs, custom ASICs for data centers. So they get much higher ASPs, much higher margins, and this product line has almost become, an unattractive product line for the leaders in the business. For SEMO, it's a massive new TAM upgrade with much higher profit margins. So it's a huge deal from Silicon Motion's perspective.
And just frame that so if for people who are listening to it now have never heard of it, it's $93 and change here, and you're thinking what 2027 you're pricing it off of? Is that your mental model or 2026?
No, I have the $10 target in really 28. So 27 you'll start
So the
discounting
forward, so the forward multiple on in 27.
it.
So let's
Yeah, it's probably eight-ish dollars then. So it's an 11 PE on 27 earnings, 12 times earnings on 27. That's a cheap
and
stock. Growing, growing organically 15%, 18%, some mid-teens growth. That's
yeah.
very solid
In this in
revenue.
this in this market I would agree that's a cheap stock. So you
That's
you
cheap.
know if you share that view, then you can buy it here. That's not a problem.
No problem. Yeah, I'm just waiting for a buyable dip to buy more stock. If it's 100 to
Yeah,
78 or 100 to 82 or 100 to 73, I would buy a dip like that and add to my position for sure.
yeah. It seems like that if you're long, it's not like oh I'm in a hurry to add on a. But it just it's off 10% off the recent high. To be fair,
Yeah,
right?
yeah, but
Um,
10% doesn't fit my down a lot rule. So
no, no, no. I'm just
the
trying to
dip
frame this for
when,
people who are
when
listening.
when I buy a position, I try to buy. I say a company needs to have its own private bear market. Okay, and that by definition that's 20%, but that's the S&P. And when you deal with betas like I do, right, it's probably closer to 25 or 30. So that's the kind of dip that I try to wait for to buy. If the business is exploding and I know it's never going to get there, then I'll jump in down 12% or 15%. But I don't have an edge on the short term numbers, meaning the next quarter. I feel very strongly about 26 and 27, and calendar 20 the 28 if the world holds together, obviously. So anyway, But let's spend 5 minutes on the third company that I recommended that has gone down. As I said, like you said, you don't make them all. You don't pick all winners. But the company I recommended here a couple of months ago was called SimilarWeb, and it's about a $700 million mark enterprise value Israeli software company, and it's one of the companies that scrapes the web and transactions, and I guess they call them events. They analyze billions of events on computers and from cell phones from tens of millions of websites and apps to determine sources, how ads are working for industries and the competitors they're in, and how what the source of leads are, whether it's social networking or pop up ads or any kinds of things like that. They're basically one of the few companies. The comparable is Google Analytics, but Google kind of keeps its stuff proprietary, and then you have to pay for it. And these guys, they scrape the web for all kinds of transactions and click throughs to determine what's happening from your desktop, from your cell phone. And now they've introduced an AI product because, Ben, you remember how we talked about, Google losing its search monopoly once I do a search in another, AI product? Well, that's going to broaden the market for this company's IP quite significantly. So they sell their data as a SaaS business, right? Software as a service. And all software as a service. Kramer has been lamenting this because he's in love with Benioff at Salesforce. And Salesforce is bitching about their valuation and how they're going to win from AI, not lose, right? So SaaS businesses are at risk from AI writing code, okay? Klarna said they recreated Salesforce and Workday, I think, last year from their own internal engineers, software engineers in AI, and turned them off. 100% of their seats gone. And now they get the same product services from their internally developed one. But this company doesn't sell a software that processes data. They provide the data, and then they'll sell raw data, and they'll sell it after people analyze it. They analyze it. So they'll sell it both ways. So in a world where AI and the result of AI searches from other LLMs, right, and other AI products are going to consume a lot of future searches, in theory, that product capability should be, worth something. It should generate significant value and revenue and profit going forward. So I think that this company is a beneficiary from AI as a SaaS business, and not going to be beaten to hell by as some might be. So where's the stock? What's my valuation target and fundamental target? They've been growing, low to mid teens the last few years. I think that's going to accelerate. They used to have 35% of their business with enterprises. Now it's 65. They got their first $1 million a month ARR contract or 8-figure contract. We think it's OpenAI, and we think OpenAI is now probably their biggest single customer. That's good and bad, obviously, right? Because they have to. We don't know if they're going to be able to pay their bills in 2 years, right, Ben? So that's a risk. But if all the other AI providers start adopting this and enterprises start adopting this, and a lot of this is consumer related, right? And B2C related. So you have to be comfortable with the consumer economy, at least the online consumer economy. But if you're comfortable with that, I see revenue growth accelerating to 20%. Okay. And I see a 30% free cash flow, 80% gross margins, only 15% R&D. So that's very good. So they're investing very heavily in SG&A in their go-to-market and sales strategies to generate accelerating revenue growth. They added 2 new products. They never had an app product based one. It was all desktop and laptop prior to this. And they didn't have the AI product. That just emerged in the last 6 months. So I think it's easy that they can grow 20%. Maybe they could squeeze out a few 22s or 24s. I don't know. We'll see how big this thing gets. But if they can squeeze that out, to have this at 1.75 times my estimate for 2027 revenue is absurdly cheap. Okay, the stock's been in the mid-teens, SNWB a couple of times already. So I mean, I think it might have been priced at 20 when it came out in 2021. So there's no the peer group trades at 6 to 7 times sales if you have 20% revenue growth in the SaaS companies these days. So it would easily be a double or a triple from $8.80 if they grow their revenue between 20 to 23% over the next 2 years. It's absurdly cheap for the fundamental characteristics of the business.
What
And
about
it's been a
energy here?
energy. I mean, like you said, it's the most boring and the most unexciting and the most depressing part of the stock market. And I have very little exposure to the commodities. And I know I've been talking about energy because a good chunk of my income portfolio is in MLPs, but they're all toll takers. They're all pipelines, gatherers, processors. So I have not been willing to make a bet on oil or natural gas prices, except for one company I own that is a royalty company. It owns the royalties for oil and gas production, and that's Kimball, Royalty Partners (KRP). But I think oil's getting cheap enough now to where there's a high probability that oil has a rally or a bull market in the next 2 years. And if it's off of 56 or 58 or 52 or 48, I don't know. But there's definitely going to be a slowdown. There's definitely already been a slowdown in drilling. And, there's, in my mind, there's not never been a drill baby drill, but there has been a pump baby pump. And OPEC, Donald Trump has OPEC pumping more than they should and using geopolitical pressure to do so. And, there's a little bit of an oversupply in the current oil markets of about 1 million barrels a day, I believe. So I'm not, I believe natural gas has a much better outlook. But even the natural gas guys, right? I believe natural gas production in the U.S. year on year is up 6 or 7%. I mean, that's pretty crazy growth. If nothing grows at 6 or 7, electricity demand is growing 2%. So the natural gas guys have been able to saturate the market once again and drop natural gas back to $3. So it's hard to get. It's easy to get excited about the demand for power that's going to be solved by natural gas as a fuel source, but it's hard to get excited about the natural gas pricing when the industry can shoot itself in the foot by over drilling at a hint of $4 per MCF natural gas. So I own the pipelines, I own the MLPs. They've been disappointing stocks this year, but I own them at about a 14% cash on cash, dividend or distribution return yield, and they're sort of in my portfolio forever. So I'm not ragingly bullish on energy well, in the near term, but over 2 years I could see there being a nice rally. And you and I have talked about the gold to oil price. It's at a record high level, and I don't know how you can have an inflationary trade for lots of metals and have a deflationary bust for energy, but that's what the market is offering us right now.
I'm not sure it is, to be honest. Like, if you look at the gold to copper ratio, that thing is gone, or, copper to gold ratio, you can usually line that up against, like, the 10-year or the long end of the curve, and they follow each
Right?
other pretty well. And,
Right.
oil to gold, same thing. Oil to gold, copper to gold are kind of telling you deflation more than inflation. And I know, like, there's this massive narrative of debasement, but like I don't see it. Like I see
They call it
oil on
it's
its
got
way
a
to
name. It's
fifty
called
bucks right now,
yes,
and I
it's
see
got a name. It's
copper
called the
like
debasement
lagging.
trade. And then they've already coined the term the debasement trade, and that's why crypto goes up, and that's why gold goes up. A lot of people contend. I don't
Yeah,
I
I
don't
don't
buy
know. I
it.
mean, like even Bitcoin. Like I'm looking right now, Bitcoin's down 1.3% today. And if you look back, honestly, at Bitcoin, it usually leads the Nasdaq by a couple of weeks. Like if you go back to November of 21, so the market peaked out basically more or less in mid-November, right before the Rivian deal. There's always a deal that kind of marks the turn in a market, and
Right.
and Bitcoin had popped in, and November 8th was the kind of high, and then it was like down only for a while, and the Nasdaq didn't actually start selling till the beginning of January, and you kind of saw the same thing in the spring, or not the spring, but I guess Q1, where you had like they'll call it like right around my birthday, January 13th or something, Bitcoin topped and it started selling, but then the Nasdaq went and hit one more high on the week of February 10th to 18th. I think it was the 18th that hit it. And then so it had leaked before it. So now I'm just saying, as we see this rally today, and we see, the volatility of the market going from all-time high, then down 5% in less than one trading day to ripping up and then retesting and now ripping higher again. Keep an eye on Bitcoin because, I think that just from a liquidity standpoint, it's worth keeping an eye on because some of these things are just not lining up to me. But then again, I see yesterday there's some company called Velocity Shares that filed for 27 triple levered single stock ETFs and like another like 10, I don't even, quintuple levered ETFs. Quintuple. That means 5 times leverage. So that means, and we're talking about stocks like AMD and not low vol stocks. So
Right.
if you're talking about a stock with 3 to 4% daily vol like a Tesla, you have no business having a product that's a 5 time levered because it just takes one 20% move and your equity's gone. And these things just trade with this decay. I mean, they're just awful products. I can't believe,
Right.
the SEC is just completely out to sleep on all this.
Yeah. Well, Ben, if the market were a city, we've passed a sign that said "Entering Stupidsville." Okay. So once you're in Stupidsville, and there's no red lights, there's no stop signs, there's no speed limits. Anything goes.
And,
You can't
it
expect
does,
rationality. You can't
it
expect
does.
rationality to prevent bad driving in Stupidsville.
I read a story about how Stan Druckenmiller had some young traders working for him and said that young guys are naive enough that you want those guys in a bull because they've never
Yes.
been scarred by the bear and know what can happen. And so, like, I do think that there is this like invincibility like complex combined with the short-termism of pod shops and leverage like all combining into one thing where okay, we got scarred in COVID, but then they put a bazooka to get the market back up. Then 22, when you have the deficit reduction and then you have the Fed raises rates combo was, and then also the commodity bull from the war. So you got the triple hit in 22. That was obviously too much. But then, since then we've had another ripper up, and it just strikes me as a very interesting thing that with the tariffs as the new tax and clear signs of growth degradation all over the globe, um, that somehow we sit here at these high levels. Whereas I don't know, I guess China, there's a lot of liquidity coming out of there, but it seems very precarious. But at the same time, back to what I started with, the naive guys, like it's easier to ride the bull if you don't, especially if you're not a dinosaur like us who's been around .com or the GFC. I mean, there's a whole generation of traders that have never seen a true prolonged bear market and what can happen in that. But I will say this: it does seem that the credit markets have started to get a little weaker. We had these two high-profile bankruptcies in September in First Brands and Tricolor, and now people are pointing to Jeffries and they're pulling money out of Jeffries, And it reminds me a bit of, if you remember, the summer of '07, when the bank formerly known as Bear Stearns had two credit funds that literally went, like, got smoked. And then I don't remember who it was that bought them. It might have been UBS, but somebody bought them in June of '07, and then 2 months later you saw the quant blow up. And that's when the GFC really started. It was in August of '07. The funding market started to get a little wonky. Um, so I don't know. Keep an eye on it. I mean, since we've been talking, Bitcoin's down $1,000. So I don't know. I'm
Well,
not a
man,
buyer here. Is all I'm saying.
the implosion of the private credit market is a topic for another discussion and another day. But yes, there's a lot of stupidity there as well. So
Yeah, I think.
just note my recommend. My similar way. It's down a lot. It's compellingly valued for what it is, and
Yeah,
it has
yeah.
solid fundamentals and accelerating fundamentals. And obviously, AI is a threat, and it could take the whole SAS business, including theirs, and nick it. I don't know, but I think it's a good bet at record highs and record valuations in the stock market to buy a stock at about 2 times EV to EBITDA with 80% gross margins growing 20%. It's worth the gamble, in my opinion.
Yeah, I think that that's a SIMO. I think that's a good idea. It's not a high flyer. It's got a decent story. They're growing, and a reasonable multiple. I think that those are the kind of things that you kind of got to look for if you want to be long. Because there's always, look. I will say this: if you cast as wide a net as I do across different asset markets, there's always something to do. There's always stuff
Yes.
that's cheap. There's always, whether it's, it can be in bonds, it can be in volatility, it can be small caps, it can be different sectors. There's always stuff, different countries, right? Internationals had a banner year this year. So,
Yep.
I think people, myself included, everyone gets sucked into it a little bit, is that we get so US focused because the US equity market is such a high frequency, large percentage of the global liquid risk markets. And I don't think the average participant, even institutional equity guys, really don't know bonds or understand rates or traffic in rates, other than maybe they're in the money market with some of their cash and stuff. Um, so we'll see. I think we ran long enough here, buddy. I just noticed the time. You got anything else, or let's close this shop down?
I'm good for today.
All right, let's call it. All right, I'm Ben Brey. It's Robert Marcin. If you want to hear us on our new podcast talking about football, we'll let you know about that. But in the meantime, we'll be back here giving you some stocks and market commentary. It is October 15th. Come join us tomorrow. Check us out at wallstreetbeats.com. Thanks, and see you soon.
Bye. Thanks, guys.
Thanks.